The key risks facing U.S. healthcare and pharmaceutical companies in 2018 involve challenges to pricing power and profitability, and these are coming from several different angles. We see it in the form of regulation, we see it in inside and outside industry competitive threats, and we see changes in the behavior of healthcare consumers. Basically, as healthcare spending continues to grow, patients and payers are struggling to meet the financial burden, and they're increasingly pressuring companies to bear some of the costs. These forces will influence certain segments of the industry more than others. We think that healthcare providers focused on inpatient services, pharmacy benefit managers, drug distributors, and generic pharmaceutical manufacturers will face the biggest challenges in defending the value proposition of their business models. Issuers with stable rating outlooks in those sectors have both relatively defensible operating profiles and good headroom in the rating sensitivities.
The two key risks to the not-for-profit sector include our belief that legislative uncertainty will continue, and perhaps even accelerate in 2018, and that industry-wide challenges will place growing pressure on operating margins. Let me take the second part first. Margin pressure is coming from growth in Medicare volumes, which are growing by 10,000 enrollees a day, and the increased usage of Medicaid patients. Both payers chip away at profitability. This is compounded by limited rate increases from commercial payers, increasing salary and wage expense, increasing pharmaceutical expense, particularly in regard to specialty drugs, all during a period of time that providers are continuing their journey from volume to value. We do expect increased volatility in operating results among individual providers, with a negative impact felt most acutely at the lower end of the rating scale. Then compound all these operational challenges I just mentioned in the current legislative context, with recent attempts to repeal or replace the Affordable Care Act, or the ACA. The current administration still appears committed to some form of repeal and replace, but it appears to have morphed into piecemeal efforts to limit the ACA, such as executive orders and now the tax reform overhaul bill that threatens the individual mandate. These incremental efforts are beginning to eat away at the ACA and have the very real potential to have a negative impact on the acute care sector. In addition to federal legislative uncertainties and current actions, the sector will also see the first full year impact of disproportionate share cuts in 2018, and we expect those to negatively impact profitability.
Regulation is always an important source of potential disruption for healthcare companies. But we think that federal regulations that take pricing power out of the hands of the industry, like Medicare setting drug prices, are unlikely because of a lack of political will to coalesce around such a policy. But addressing the questions of access and affordability that are at the heart of the Affordable Care Act debate is critical to the profitability of the healthcare industry over the longer term. While a policy solution could accelerate disruption to business models, we see that secular shifts are already occurring, and that's happening regardless of the developments on the political front. Technology is increasingly enabling decentralization and moving patients out of hospitals and other bricks and mortar settings. Big data and analytics allow for enhanced price transparency and encourage consumerism. We have seen established industry players begin reshaping the landscape, and we believe that outside forces could seek to exploit the inefficiencies that contribute to the high cost of U.S. healthcare. Unlike the retail and hotel sectors, outside disruption has not been prevalent within the healthcare industry because of the complex nature of the relationships between suppliers, customers, and payers. But we think that successful disruption is possible, since the industry is not protected by a regulatory moat. However, it would require significant capital investment and a high degree of strategic expertise. We think that the healthcare business models best positioned to defend profitability in the face of disruptive headwinds exhibit innovative depth or commoditized breadth. For example, an innovative pharmaceutical firm focusing on only a handful of therapeutic areas, or a healthcare provider owning a continuum of care delivery in a geographic market.
In terms of disruptions to the sector, I have to start where I left off and say first and foremost the impact of legislative uncertainty and maneuvering is likely to be the biggest disruptor to the sector. This administration has begun procedural maneuvers on the periphery of the ACA through executive orders, although the certainty and timing of any final adoption remains unclear, and Fitch expects multiple legal challenges. The use of executive orders does raise the very real possibility that over the near term, additional key provisions of or around the ACA might be eliminated or materially modified. Most particularly, there is, as a part of the tax overhaul bill, specific mention of a repeal of the individual mandate. This or any change to the ACA that reduces coverage, shifts more cost onto patients, or reduces overall program funding or reimbursement to providers would be considered a negative credit development for the sector. Another legislative uncertainty is, as part of the tax reform overhaul bill, the potential elimination of tax-exempt status for debt issuances. Not only will this increase cost of issuance going forward for the public sector, a very real concern over the immediate term is that if the debt market will be all but closed until this issue is resolved and bond counsels can issue a clean opinion. The other large disruptor in the sector is going to be merger and acquisition activity, which we expect to pick up in 2018 with perhaps a return to the mega mergers we saw just a few years ago, with very large systems combining together versus piecemeal M&A activity, which has been more the norm as of late. Another aspect of M&A activity is the growing interest and presence of non-traditional competitors in the sector. Think companies like Apple, CVS, or Amazon. They're very well capitalized, very innovative, and see a segment of the economy, almost 20% of our GDP, that they've largely ignored to date. Our expectation is that one or multiple of these non-traditional competitors will enter the healthcare sector in a meaningful way very soon and begin to change the delivery of healthcare and be a major disruptor in the sector.